Two guys, same job, same salary, same 30 years of disciplined investing. One of them is going to retire thinking he won. He's going to be mostly wrong. Here's the thing about retirement accounts. The number on your statement and the number you actually get to spend are not the same number. And nobody tells you that up front. Not your HR department, not the app, not the guy at the barbecue who won't stop talking about his 401k. I'm Chris, and today we're running the full calculation, not the one that makes one account look good, the one that actually tells you the truth. Stick with me, because the ending is going to change how you think about your money. Meet David and Elijah. Both are 30 years old. Both earn $80,000 a year. Same city, same federal tax bracket, same goal. Retire at 62, never touch another alarm clock, and stop pretending they like their commute. The only thing that's different is the account they chose. David goes with the 401k. His employer matches up to 4% of his salary. So David contributes $8,000 a year and his company drops in another $3,200. That's $11,200 going into his account every year, and none of it has been touched by the IRS yet. David's paycheck barely flinches. Pre-tax money feels like a cheat code. Elijah opens a Roth IRA. He maxes it at $7,500 a year. Every dollar Elijah puts in has already been taxed. His paycheck feels lighter from day one. No employer match, no tax break on the front end. At every early check-in, David looks like the obvious winner. His balance is higher, his paycheck is bigger, his employer is handing him free money. But David has a problem he can't see yet, and it's going to cost him more than he ever expected. Let's give David his credit where it's due. Putting $8,000 into a 401k lowers David's taxable income by $8,000. At his 22% marginal rate, that's $1,760 back in his pocket every single year. Not someday, right now, this year. And then there's the match. His employer's $3,200 a year is essentially a 40% instant return before the market does anything. That's not a tax strategy, that's free money, and it compounds. By year 5, David's 401k sits at around $70,000. Elijah's Roth IRA? About $49,000. David is ahead by $21,000, and he knows it. He's probably mentioned it. Meanwhile, Elijah is paying taxes up front. At his 22% rate, he effectively needs to earn around $9,600 in gross pay to put $7,500 into his Roth after taxes. David only needs to earn $8,000 to put $8,000 into his 401k because that tax bill doesn't exist yet. That word, yet, is doing a lot of work in this story. Here's what David's 401k statement doesn't show him. Every single dollar in that account, his contributions, his employer's contributions, 32 years of compound growth is owed to the IRS the moment it comes out. The 401k doesn't eliminate the tax, it postpones it. And there's a difference between a delay and a deal. When David starts pulling $65,000 a year in retirement, the IRS treats it exactly like a paycheck. After the standard deduction, he's looking at roughly $5,800 in federal taxes every year just on his withdrawals. If he's in a state with income tax, add more. Now, here's where it gets worse. At age 73, the IRS stops being patient. Required minimum distributions, RMDs, kick in. David has to start pulling money out of that account whether he needs it or not, because the government has been waiting 40+ years for those taxes, and they're done waiting. If David's 401k has grown to $2.8 million by 73, which is realistic at 7% annual growth, his first required withdrawal is around $105,000. That's not optional, that's not negotiable. And he owes income tax on every penny of it, which could push him into a higher bracket in retirement than he was in during his working years. There's one more hit. When David starts collecting Social Security, let's say $26,000 a year, his 401k withdrawals push his combined income high enough that up to 85% of those Social Security benefits become taxable, That's money he paid into his entire career, now getting taxed a second time because of where his retirement money is sitting. The 401k is not a bad account, but the number David sees on his statement is not his number. Part of it has always belonged to the IRS. He's just been holding it for them. I'm not here to sell you the Roth, so let's be honest about its limitations. The contribution limit is tiny. In 2026, Elijah can put in $7,500 a year. David can put up to $24,500 into his 401k, more than 3 times as much. If you're in your peak earning years and trying to shelter as much income as possible, the 401k isn't even close. There's no employer match. Nobody is matching Elijah's Roth contributions. That 4% match David gets, $3,200 a year, compounds over 32 years into roughly $375,000. Elijah has to generate every dollar of his retirement balance himself. No shortcuts. There's an income ceiling. If Elijah's career takes off and he starts earning above $150,000 as a single filer, his ability to contribute directly to a Roth IRA starts phasing out. Above $165,000, the front door closes. There are backdoor strategies, but they add complexity most people never bother with. And there's an upfront cost nobody likes to talk about. Every year, Elijah pays roughly $1,760 more in federal taxes than David because his contributions aren't pre-taxed. Over 32 years, that's nearly $56,000 more in taxes paid. If David had invested those annual tax savings in a brokerage account at 7% growth, they'd compound to over $200,000. That's real money Elijah didn't have access to. And here's the uncomfortable scenario. If tax rates somehow go down in the future, unlikely given the national debt, but not impossible, Elijah locked in today's rate when a lower one was waiting. He paid early for a deal that got cheaper. For the first few years, David's lead is obvious, but somewhere around year 7, something starts happening that doesn't show up on any statement. By year 10, David's 401k, roughly $166,000. Elijah's Roth, $118,000. David is ahead by $48,000, clear lead. But ask a better question. How much of David's $166,000 is actually David's? If he withdrew it all at a 22% tax rate, roughly $36,600 goes to the IRS. His real after-tax wealth is closer to $129,400. Elijah's $118,000, every penny of it is his. No asterisk, no future bill, no guesswork. The gap just shrank from $48,000 to $11,000, and almost all of that is the employer match. By year 20, David, $492,000 on paper. After taxes, $384,000. Elijah, $351,000. After taxes, $351,000. Real gap, $33,000, and almost all of it is the employer match. Strip out the match, and they're essentially tied. Think about that. The entire advantage of the 401k, the tax deferral, the higher limits, the paycheck benefit, nearly cancels out against the Roth's tax-free growth over time. After 32 years, both retire at 62. Here's where they land. David's 401k balance, approximately $1,320,000. He's a 401k millionaire. He worked for it. His employer put in $102,400 in matching contributions. The market did the rest. That number feels earned because it was. Elijah's Roth IRA balance, approximately $944,000. No 7-figure milestone, no bragging rights at the retirement dinner. Just $944,000 that is 100% his, tax-free, forever. Now they both pull $65,000 a year. David pulls $65,000 from his 401k, federal tax bill roughly $5,800, take home about $59,200. State taxes may take more.
Elijah pulls $65,000 from his Roth. Federal tax bill, zero. Take home, $65,000. Every dollar. That's a gap of $5,800 a year. Over a 25-year retirement, David pays roughly $145,000 in federal taxes just on his withdrawals. Add the Social Security tax drag from David's 401k income, pushing his combined income over the threshold, and you're looking at another $65,000 in taxes over 25 years. Total federal tax cost for David over retirement, somewhere around $210,000. Total for Elijah, close to zero. David still started with a larger balance, but once you run the full math, the gap between their actual spending power is dramatically smaller than their statements ever suggested.
Age 50. Life doesn't care about your retirement timeline. Maybe it's a medical bill, a parent who needs help, a business opportunity you can't let pass. Either way, David and Elijah both need $30,000 immediately. David goes to his 401k. He's under 59 and a half, so the IRS charges a 10% early withdrawal penalty, $3,000 gone. Then he owes income tax on the full $30,000 at 22%, another $6,600. Out of a $30,000 withdrawal, David walks away with $20,400. He needed $30,000. He got 2/3 of it. Elijah goes to his Roth IRA. Here's a feature that almost nobody knows about. You can withdraw your contributions, not the earnings, just the money you put in, at any age with zero taxes and zero penalties. Elijah has put in $150,000 over 20 years. He pulls out $30,000. No penalty, no tax. He keeps all $30,000. Same emergency, same amount needed. David lost $9,600. Elijah lost nothing. The Roth IRA isn't just a retirement account. It's the most powerful, flexible emergency fund most people don't know they're building. Here's where I'm going to give you something most of these videos won't, a real answer. The 401k wins on employer match. It wins on contribution limits. It wins on reducing your tax bill today. It wins on automation because the money comes out before you ever see it, which means you can't spend it. For high earners who blow past the Roth income limits, it might be the only tax-advantaged door left open. The Roth wins on tax-free growth. It wins on flexibility. It wins on no forced withdrawals, ever. It wins on estate planning. Your heirs inherit a Roth tax-free, while David's kids will owe income tax on every dollar they pull from his 401k. And it wins as a hedge against rising tax rates, which, given a $36 trillion national debt and climbing federal spending, is not a crazy thing to plan for. Neither David nor Elijah made a wrong choice. They both made an incomplete one. Here's the order that actually works for most people. Step 1. Capture the match. Contribute to your 401k up to the full employer match. If your employer matches 4%, put in 4%. That is a guaranteed 100% return on day one. Walking away from it is the most expensive financial mistake you can make. Step 2. Max the Roth. Once you've got the free money, put $7,500 into a Roth IRA. You've already claimed the employer match. Now build the account the IRS can never touch again. Step 3. Go back to the 401k. If you've still got money to invest, increase your 401k contributions toward the $24,500 limit. The pre-tax benefit still has value. The higher ceiling gives you more room. Match first, Roth second, 401k third. This isn't a theory. This is what real certified financial planners actually recommend when someone sits down and asks the question without an agenda. It captures the free money, it captures the tax-free growth, and it avoids the trap of going all in on either account without understanding what you're giving up. The real mistake isn't choosing the 401k. It isn't choosing the Roth. The real mistake is letting someone else's highlight reel, a TikTok, a coworker, a finance influencer with a clean background and a ring light, make the decision for you without ever accounting for your salary, your tax bracket, your timeline, and your retirement vision.
The account that wins for you is the one built around your numbers, not a story about two fictional guys, not this video. This video is just the starting point. If you want to go deeper, if you want to see how both of these accounts stack up against a regular taxable brokerage account with no contribution limits and no withdrawal rules, that video is coming, and the math will surprise you. Until then, run your numbers, question the headline, and don't let anyone sell you an always in personal finance, because in this game, context beats certainty every time. I'm Chris. Subscribe if you want the real math. See you in the next one.